I believe with all my heart and everything that I know that we've already begun the transition to hyperinflation. We're going to see more borrowing, more money printing, more inflation, because they have not killed that beast that they created and continue to create. And I think it'll become very obvious 2025. I believe that they're going to try and hold it steady through the elections, so not have a big crisis before then. But after that, I think all the gloves are pretty much off. In my opinion, what they have in mind for us takes us back to feudal times. I think the banking sector is extraordinarily sick. Well, every single bank is underwater. And even a quarter of a point, that's not going to do really anything to these valuations. And if you go to the purchasing power of the consumer dollar, the Federal Reserve tells you themselves, if you look on that left-hand index, what's down at the bottom? A big fat zero. And we're not very far from that. It's critical that there is a zero on that index. So they well know that the currency is going to zero. Mm-hmm. And what happens when we get there?
Hyperinflation is usually a rate of at least 50% per month by the technical definition. Do you literally mean hyperinflation as that technical definition?
I think it'll be even worse than that.
On the Spot with Michelle McCory is brought to you by Goldback Inflation-resistant 24-karat gold currency.
Hello, I'm Michelle McCory. Thank you again for joining us. My next guest has long been warning of the collapse of the financial system, a banking crisis, and banking sector consolidation. Since her last appearance, U.S. regional bank consolidation has indeed been accelerating. 54 U.S. bank M&A deals were announced in the first 2 quarters of this year. This year's deal volume is so far on pace to surpass the 99 deals announced in 2023. That's according to S&P Global. More than 2/3 of banks in the KBW Regional Banking Index are likely to be acquired in the next 12 months, according to analysis by Reuters using StarMine M&A data. And we're also seeing a surge in bank branch closures. Last year, nearly 2,500 bank branches in the U.S. were shut down. As of the end of last year, the number of bank branches in the U.S. has in fact shrunk by more than 20% compared to 2009. And so far in 2024, between Bank of America, Chase, U.S. Bank, Capital One, PNC Bank, Wells Fargo, and TD Bank, an additional 400 plus branches have closed. Meanwhile, U.S. regulators are making significant changes to their proposed bank capital rules. Banks were expecting a 19% increase of capital that they must hold, but that has now been practically halved and cut down to a 9% hike in capital requirements. Well, Lynette Zang has been sounding the alarm over the health of the banking system for a while now, while warning that the dollar's currency life cycle is nearing its end. She says the uninversion of the yield curve has started the clock ticking towards a major recession, but that this time will be far worse than before, with a huge crisis and hyperinflation hitting as soon as 2025. Lynette Zang is the founder and CEO of Zang Enterprises. She's almost 60 years of experience in the financial sector, including as an investment banker with Larsen Lehman and American Express. In her previous position, she was the chief market analyst at ITM Trading. Lynette is an economist that's been involved in the markets at some level since 1964 as a student, banker, stockbroker, and precious metals analyst and currency analyst. And she's been studying currency life cycles since 1987. And of course, Lynette is also a Kitco fan favorite. Nice to see you again, Lynette. Welcome back.
I'm very happy to be here, Michelle. Thank you so much for having me. You made me sound better than I am.
Lynette, it's all substantiated. It's all true, including the tremendous experience that you have in the financial sector, which always defies your appearance. But nonetheless, you come to us with a wealth of experience and knowledge, and we want to get into that. And I do want to get your macro outlook. But before I do, I want to start with giving our viewers some insight into the basic principles that guide your theories, because you've been studying currency life cycles since 1987, I believe, and you've discovered that there's similar social, economic, and financial patterns that occur throughout the stages of a currency's lifetime. And given that that is a big principle of your thesis, why don't we start with the basics? What is a currency life cycle, and where are we in it?
Well, Michelle, like everything else, like humans, just kind of put it down to a level that people can understand. I'm about to be 70 in another month, and I have a 9-year-old granddaughter. And I guarantee you that you're not going to look at me and think I'm going to be 10 next year, and you're not going to look at her at 9 and think she's going to be 70. So there are these very easy to recognize patterns that occur in the life cycle of everything, and certainly in the life cycle of a government debt-based currency. And so if we can learn to recognize what's happening, then you know where you are in terms of that life cycle. And because we have so much data, there's over 4,800 currencies that have gone away. I mean, I have some in here. Then, you know, if you know what you're looking for, you know what the next most likely outcome is. And therefore, you can get into a position to sustain your current standard of living, and dare I say it, even expand your standard of living to be in a better position on the other side. But just like humans, it's easy to recognize those life cycles as soon as you know what to look for.
Right. And you were waving some banknotes around, which are worthless pieces of paper right about now. I imagine the majority of them. I can't see exactly what you have there. But, you know, that's an important point to re-emphasize to our viewers, because I like to say that, you know, we suffer from recency bias. We know the dollar. We've grown up with the dollar, but we forget that it's only been the global reserve currency for what? About less than
10 years, something like that. Well, no, it was in 48.
Bretton Woods, yeah.
Right. So,
so talk us through some of the other examples. I mean, I always like to say, and our viewers mentioned this in the comment, I always like to say that there was a time when the Portuguese escudo was the global reserve currency, when Portugal was one of the leading empires in the world. So again, remind our viewers how currencies have come and gone before we get to where we are right now.
Absolutely. And the UK was the last one to hold that title before the US took over. And it's typically whoever has the greatest army and the most amount of wealth, and actually the wealth was the gold that was held by the government, and that's who usually became the world reserve currency. And that really is such a huge advantage for the US when we took over as the world reserve currency. And then again, prior to, well, in 1971, the petrodollar, you were forced, other countries and governments and corporations, and even we know this in individuals, because if you travel, you have to convert your currency to whatever currency that's used in the country you're traveling to. But corporations and governments, if they're going to buy lumber or oil or medicine or anything, having that status as the world reserve currency creates a false or foundation and ownership of that currency, because you've got to hold it. So therefore, it kind of strengthens it. And in the beginning, it makes sense. Like when the US took over as the world reserve currency, we had the most gold reserves of anybody in the world. We had the largest army of anybody in the world. So it kind of made sense. But once you're in that position, you have a lot of advantages. And I think that us in the US, we have no idea what a middle class looks like in the rest of the world, because we have really enjoyed that favor. Having said that, as soon as they have that position, then the governments and the central banks start whittling away and getting rid of the gold. I mean, in the 60s, there was a run on the dollar, right? I'm going to back up to move forward here for a second. When we were actually fully on the convertible gold standard, you could walk into the bank with a $20 bill and walk out with 1 ounce of gold. Gold requires fiscal responsibility. So if you remove gold from the system because you don't like what the government's doing, then it tightens those controls. So the public actually had control. They took that away from the public in 33 because they wanted tax and spend, but foreign governments still had that ability. So once those foreign governments realized that what the U.S. was actually exporting was inflation to the rest of the world because we were printing more dollars than what we had committed to maintaining, $35 to an ounce of gold, but we were funding wars. So, and that's how that happens. There's another whole story behind that. But once you start funding those wars, then the value of the currency starts to decline because you're doing, oops, that one didn't work. You're printing money to spend on the war. And so ultimately what happened is there was a run on the dollar in the 60s and Nixon took us, they say, close the gold window, which means that it's no big deal, but it's a very big deal because foreign governments couldn't convert the dollars they were holding into the gold that we were holding. But by the time he did that, it was because we had less gold in deep storage than we did prior to the confiscation in 33. So that's a repeatable pattern, is always war. It's always inflation. There's typically something around women's rights and civil rights. Markets drop. So there are these repeatable patterns that I'm seeing today. And so what that tells me, additionally, there's less and less purchasing power. And officially, we have 3 cents left out of the original dollar's worth of purchasing power. So what that tells me is that we are at the end of this experiment. Mm-hmm. Right? It's also
symbolic, Lynette, that even your money printer, one of them, is not even churning out any more notes, right? That the first one's not working. Some symbolism there of how much we're coming to the end of this printing experiment, potentially. Okay, let's talk about where we are, though, in the current life cycle.
Yes.
Because you mentioned that we're only at 3% of the dollar's purchasing power. And that's according to the Fed, right? That's not conjecture. That's not speculation. This is what the official government data will tell us. So talk us through what we call the FRED chart and explain to our viewers what this means.
Right. Well, the FRED is the Federal Reserve Education Department. And it's one of my very favorite websites because even though I know they jury rig data to make it look like they want to, I think they're more honest in there. And if you go to the purchasing power of the consumer dollar, the Federal Reserve tells you themselves, if you look on that left-hand index, what's down at the bottom? A big fat 0. And we're not very far from that. And that is the inflation that is built into the system that enables a lot of the stuff that we're seeing today. And so, yeah, that's my favorite chart. If you said I only had one, I could tell you the whole history of the currency in that one chart.
And it's showing us that the government is acknowledging that there are 3 cents left to the dollar, right? That the purchasing power of the dollar has now declined from 100 cents, $1 to 3 cents.
Correct. But it's critical that there is a 0 on that index. So they well know that the currency is going to 0. Mm-hmm. And what happens when we get there?
Right. Well, what does happen when we get there? You have been cautioning that is a development that we can expect for quite a while. And I understand that your outlook on the current macro situation is making you concerned that getting to that zero is approaching even faster. So bring those concepts together and give us your current macro outlook.
Well, in 2008, I was 100% convinced that the system died. And so that's when I started doing a lot of my prepping other than gold and silver, which is sound money, because the only tools left for the Fed or any central bank is money printing and interest rates that are supposed to inspire even more debt than governments, corporations, or individuals have already taken on. And that's huge because they keep telling us that it's not sustainable. Well, it hasn't been sustainable in a really long time because what we're actually doing is compounding interest. And when you start to compound interest, if you take it to an individual level, if you have a credit card and you make a minimum payment and you're only paying part of the interest, the rest of that interest goes into the principal, and now you're paying interest on that interest. And when I looked at that, way back in 2009, when we were $13 trillion in reported debt in the US, now what, have we hit 36 trillion yet that they're talking about? But at that time, we were running, that was the first really big deficit that we were running, roughly $1 trillion. And I thought to myself, well, if we're only running $1 trillion deficit and we haven't really been doing it that long, again, go back to the Fred, you can look at that. Why are we servicing $13 trillion in debt? But one of the good features of the Fred is you can go behind it and look at the data. You can look at all the spreadsheets. And that's when I saw that we started compounding. Most of that 13 trillion was compounding interest. If you personally are compounding interest on your credit cards, are you ever getting out of debt?
No, obviously adding more and more debt, which becomes unsustainable.
Not only that, but you're leeching the ability to continue to spend. Because if you're having to spend on the interest, that's less money you have to spend on other things that you might need. And so this is all an indication that we're at the end. But we're so close to that zero. What's going to push us there? The loss of confidence.
So let's discuss where we are right now in terms of faith, in terms of confidence. We're expecting the Fed to cut rates by 25 basis points coming up next week. We've also seen what we're calling the uninversion of the yield curve. Yes. Explain why you have said that that is such a major indicator.
Well, again, if you pull up the 2 and 10-year spread, you will notice that when a yield curve inverts, and that what that really means is that the shorter duration bonds are paying more than the higher duration bonds, which is illogical, right? Why would you loan the money for a longer term to get paid even less? So we've just been in the longest inversion in history. The other time, and it wasn't as long as this, was back in the 70s and 80s when we were transitioning from a gold, at least a quasi-gold-backed system, into a pure debt-based system. So that in and of itself in this little life cycle piece is clearly an indication. But when you look at the graphs and the charts, what you see is that it starts to disinvert, and then you go into a recession. And I'm talking about an official recession because some would argue that we're already in one. And I would be in that camp. But the government gets to choose, this is actually a recession. But you can see that data. And it's happened other than the other really long inversion when we were making that transition back in the 70s and 80s. Every single time. Plus we had the sham rule, which also indicated, a recession was happening. And so we've gotten, there's not just one indicator, there's a whole litany of indicators of why I know we're going into a recession. There's multiple ones. There's less that I see. I don't see any that doesn't say we're going into a recession, honestly. And neither does Wall Street. This isn't just me saying it. You know, you can read the news, the headlines, and you can see even Wall Street is saying that. I think it was, it might have been Morgan Stanley or one of those guys just recently came out and said that all of their indicators between stocks and bonds, that diversion that was happening there was an indication of a near recession.
Okay, so assuming that this happens, right? You said that this means the clock is ticking, the uninversion of the yield curve as the Fed starts to cut rates. Articulate what your macro outlook is from this point.
I believe that they're going to try and hold it steady through the elections, so not have a big crisis before then. But after that, I think all the gloves are pretty much off. And that's why and also I'm looking at the monetary velocity and the big spike there. And that's the number of times that money changes hands, which is indicative of, I could be wrong, and I really hope I am, but I believe with all my heart and everything that I know that we've already begun the transition to hyperinflation. And that there are a number of levels of confidence that have all since 2008 gone away. But that last level of confidence is public confidence in the system, in the currency. And when Powell lowers the rates, we're going to see more borrowing, more money printing, more inflation, because they have not killed that beast that they created and continue to create. And I think it'll become very obvious. 2025 is when I would think it would start to become very obvious to the public, because I think the inflation will spike.
What becomes obvious?
That we are entering a period of very high inflation.
Now, as the Fed starts to cut rates in order to stimulate a slowing down economy. I mean, that's something that the Fed would say they're trying to juggle. They're trying to balance a slowdown in the labor market with inflation. What kind of rate cutting cycle would be needed to sort of lose on both fronts, lose the inflation war and lose the economic growth war?
They've already lost it. But when you're talking about that, it's really, really super simple. There is only one way to fight deflation, and that is with inflation. There's only one way to fight inflation, and that is with deflation. And so they were able to balance that more when we had more purchasing power. But I've yet to meet anybody, and I talked to some quite brilliant people, and I've yet to talk to anybody that can tell me what happens when we get to zero.
Right. Well, let's talk about the indications there before we get to zero. And that you mentioned the monetary velocity chart, the rate of which dollars exchange hands. Break that down for us and what it's signaling.
Well, if you look on that graph, what you see is that there was a period of time when taking on more debt actually did stimulate the economy. But that peaked in 97. And ever since then, no matter how much more debt we've taken on, it has certainly stimulated inflation and the loss of purchasing power, but it has not really been economically stimulative. It's been more transferative, right? The wealth has transferred from the many to the few. And so when you look at that graph, the times that money has changed hands basically has fallen off a cliff with a teeny blip here or a teeny blip there. So I've been watching that quite closely, because once we go into a level where now the public is really starting to get rid of the money because they're recognizing the rapid inflation, and they want to use that money when it has more purchasing power. So that's exactly what happens in a hyperinflationary state. When somebody knows that the value, their purchasing power value, is evaporating rapidly, they get rid of those dollars or euros or whatever, Argentine pesos, or, I mean, there's a whole bunch of currencies here, because that's when they start to recognize that loss of value. If they can keep it at that 2% like they talk about, people don't notice it and they don't change behavior. But behavior has changed. It's changed already. People are trading down. People are doing without. People are postponing purchases. And we're not just talking about the low-end consumer or even the middle-end consumer. We're also seeing this kind of behavior, not as great as the lower end, but even in the upper end, they're, watches, they're making fewer high-end watches and different things, because even the higher-end consumer is starting to have to make some choices.
We do have guests on the show like Kevin O'Leary who have said that, watches are a good store of value. And we have seen that change recently. There's some data on that. We'll find out about how, the Rolex index is losing power there. But look, Lynette, you're using the word hyperinflation. Okay. Mm-hmm. Now, hyperinflation is usually a rate of at least 50% per month by the technical definition. 50% per month. Okay, that's like the equivalent of an inflation rate of about 14,000 per year, if I'm doing the math correctly. That level was only reached maybe during the Confederacy, during the U.S. Civil War, according to my research here. Do you literally mean hyperinflation as that technical definition?
I think it'll be even worse than that, because this is really it. And I don't think it's just the US. I mean, this whole experiment, if money is created from debt and you're compounding interest on that debt, there are limitations to how much you can create and make things actually work and function. And we're past that point. So how can they stimulate the economy? You can look at stock markets, right? And real estate. These things have been targeted for reflation. That's what they talk about. They've got to blow that debt bubble and that price bubble up. But trees don't grow to the sky. You always have to there are always limitations, less for a government than certainly for an individual. But there are limitations, and it's that whole confidence piece. That's the really, really, really important piece here. And go ahead.
Again, Lynette, we've never had that period in the United States that it's experienced hyperinflation, let alone the world. And you mentioned faith and you mentioned confidence, and granted, people are losing faith, but it's also in people's interest to pretend that they're not losing faith. Right? The emperor has no clothes, to just kind of nod and go along with the system and not dissect it too much. We don't want to see the ugly underbelly, so we're just going to pretend that it's not there. Right? Like, why do you feel so confident that this hyperinflation kicks in? And as soon as you're saying, well, when do you expect it to kick in? And why do you feel so confident that it will happen?
Well, I actually think it's already happened, because there is this huge pervasive spike. A little bit of movement in that monetary velocity would not have bothered me, and I wouldn't have been saying that if that's what I'm seeing. But that pervasive spike tells me about the loss of confidence. Plus, this is something that, like, the Pew Institute, they check on that all the time. And confidence levels, interestingly enough, in the government are at all-time lows.
Lynette, the majority of people, respectfully, are not that informed. Okay, they're not watching Lynette Zang. They're probably not watching Kitco. They don't know. They're believing what they're being fed on a regular diet from the mainstream media, from other sources. They're not aware that the situation is so dire to create this loss of confidence of which you speak. So surely, as long as the majority, the masses, are kept subdued and they're not alerted to this fact, I mean, surely you don't have that massive crisis in confidence then, because the majority of the people are not that well informed, respectfully.
Correctly. That would be absolutely accurate. And they aren't watching me, but they are going to the grocery store. And they have to go to the grocery store maybe once a week, maybe twice a week, however often they go. And they know that they cannot buy as much as they once did. And that's what I'm saying. The diet, even here in America, and we've seen this in other countries that have gone through hyperinflation, the population trades down. So where they might have been buying steak, now all they can afford are root vegetables. And their diet completely changes. And we're already seeing that here in the US. So in the normal day-to-day activities, they know that they have to make choices, that they can't feed their family like they once were able to. And that's what erodes that loss of confidence. I mean, look at insurances. I mean, you look at everything that the normal average person has to pay for. And we had a little bit of a rapid move in wages going up, but those wages still did not keep pace with that loss of purchasing power. So no, they're not listening to me, but they are experiencing that their money just doesn't go that far and they're getting angry. And what was kind of interesting, now we're not just talking about the US here, but there are tracks of public unrest, right? And about a year ago, this wasn't that long ago that I looked at this, but it's something that I go back to and check on a reasonably regular basis. And so I checked it about a year ago, and don't hold me to these numbers, but I'll be pretty close, that there were 400 globally instances of unrest. And then when I looked at it a year later, that moved to like 900. So the instances of public unrest pretty much doubled in just a year. People are noticing that their lives have changed too much.
You mean globally? Yeah.
I mean globally. And that one, it's globally, but we're still having some of that unrest in the US as well. But this is a global issue, so I have a tendency to go global with a lot of this stuff.
Well, let's bring it back to the dollar. And again, that Fred chart, because so much of it is really right there in our faces. As you say, the dollar's value has eroded to just 3 cents purchasing power left. Mm-hmm. What timeline do you think it gets to zero by?
When that confidence is lost, when the public has had absolutely enough. And then they lose the confidence, and that happens very quickly. What is it? How do you go bankrupt? Slowly at first, and then fast.
Isn't there ways for the governments, for the powers that be, to enforce confidence?
Too late. Sorry. I wish there was a way to regain that confidence, but I think it's quite blatant that this is a club and there are winners and there are losers, and that these are being chosen by the central banks and by the government, and it's not the public. We are just about the right size to fail. But I mean, look, 2008, we had what happened in 2020. We have what's happening right now. No, I think, and here's the other thing, and the reason why I can tell you that I believe that the public is losing confidence is you look at what's happening in the gold and silver market in this country at Costco, at Walmart, at Amazon. These are huge conglomerates. And what are they doing? They're selling out. As soon as they get it in, they're selling out of gold and silver. Who goes to those places, right?
Right.
That's the public. And that's also happening on a global basis. So that's showing that the public, it may not be apparent on the surface yet, but that is certainly data that's telling you that the public is going to gold and silver. And not because they feel so comfortable and hunky-dory, but that they're nervous.
All right. So what happens when there is this tremendous loss of confidence? Because I know in the past you've said that potentially some of this could be by design, and potentially that this could be a way to usher in the currency reset. Talk us through that.
Well, when one currency goes away, another one comes into its place. And what we've been witnessing is that they want us in CBDCs, or digital surveillance currencies. So if you do something that they don't like, and we've already been doing a lot of self-censorship, but if you do something they don't like, boom, they push a button, and too bad, so sad. You have no more access to your wealth. Look at Canada. And the trucker strike, which was a perfectly legal strike, and they took away anybody's ability, or anybody that participated or supported the strikers' ability to access not just their bank accounts, their insurances, everything. That is a means of control, and CBDCs will be that means of control if we allow it. And the way that you allow it is by having all of your wealth in those fiat markets, in the stock market, in the bond market, in the markets where all you can do is convert into these dollars. That's it. So yeah, I would say that the public is probably more aware than we're giving them credit for. And they need to be, because we need to create a sound money movement, and it needs to happen on a global basis, both local and global. Because I don't know about you, but I really do not want the central bank saying, oh, you haven't spent enough money. Let's push those rates into negative, deeply negative, so that you're watching your bank account go down, even though you know you're not spending any money.
Before we get into the central bank digital currency and the community that you're advocating for as a pushback, if that is indeed the ultimate goal here, I want to bring the banking crisis into the picture here. Because you've said that part of the way to make this happen is to have a massive collapse in the banking system. Fewer banks make it easier to usher in these major changes in the monetary system. And you mentioned those purchases of gold coins and gold bars. That also happened to accelerate after we had that the banking crisis in March of last year. At the time you came on and you warned that we would start to see consolidation of the banks. As I start off on the top of this interview, the numbers are there. We are seeing less and less banks, more merger and acquisition activity. And now we've also seen actual physical branches be shut down around the world. So bring the banking system into the picture here with the collapse that you're seeing as imminent in the faith of the currency.
Well, for one thing, the 15 years of zero interest rate policy forced those banks to buy all of that government debt. So if this is interest rates and this is the market value, as the central banks ratcheted up the interest rates, the value of any of those debt holdings in the banking system collapsed to negative. So when you look at the start of the regional banking crisis that happened in March of 2023, it's because there was a run on the bank and the public got nervous and started pulling their money out, and the bank's assets were underwater. Well, every single bank is underwater. And even a quarter of a point, that's not going to do really anything to these valuations. So what they're really trying to prevent are runs on the bank. And the reality is when those banks closed, they bailed everybody out, whether it was the insured depositors or the uninsured depositors. And when you look at that chart, Well, when did they start QE? That was 2009. At that point, you can see that the uninsured deposits were just way below the insured deposits. But with all of this money that's been floating around in the system, now you can see that those uninsured deposits make the insured deposits look like almost nothing, comparatively speaking. So there will be bail-ins, but I believe that the central bank was not, and the Treasury Department, Janet Yellen, who seems to be tone deaf to me, but there will be bail-ins when we least expect it. Because once you make that deposit, I don't care what your opinion is, legally, you have loaned that bank that money. That's why nobody went to jail in 2008, because it really wasn't your money. It's all a big contract. Nobody reads the fine print. They have all the control and the safe harbor. So they can say, no, you can't have your money back. There will be bail-ins. The FDIC knows it. And that's another thing that I find really interesting, because the most current data still goes back to the first quarter of this year. Well, why? Why don't we have the second quarters, at least through the first half of the year? I don't know the answer to that. But what I do know is they have barely more than 1 penny for every insured dollar. So if they can control the implosion, maybe they can hide it a little bit more, but they really can't. They don't have any money. It's called the DIF account, DIF, and that's the Deposit Insurance Fund. And so the banks are insolvent. They're insolvent with their assets. They are gambling with your deposits. Most of their revenues are generated by trading. We are taught that, okay, you make this deposit and they pay you this much, and then they loan that money out for a little bit more. And that's how they make their money, is through that spread. That's not true anymore. They make their money once they allowed risk-taking banks and deposit-taking banks to merge. They make their money by trading. And we have no idea of the level of risk because of the level of derivatives in the banking system and the changes in accounting to hide the risk that they're taking. And that's in the Office of the Comptroller of the Currency. They do it every quarter on derivatives in the banking system. And a derivative is a leveraged bet. Debt upon debt upon debt upon debt upon debt. I mean, if anybody wants to read it, it's very scary.
I mean, we saw what happened when you had that Japan carry trade start to unwind, and the aftermath that had. And, many, I believe, including yourself, argue that we've yet to see the full extent of that.
But nothing to see here. We just covered it up real fast and see, now we're back to business as usual. No, we are not.
Well, let's talk about the bail-in idea, because you and I have touched on it before. It's an issue that gets glossed over. But as you say, when you look at the Dodd-Frank Act of 2010, it's there. It's in black and white. From a legal perspective, it's there. It allows for banks to bail in from depositors. After the financial crisis of 2008, that law was passed. And according to Dodd-Frank, you're not a customer or a depositor. You are a legally classified unsecured creditor. Correct me if I'm wrong. I believe that is the language. And that means anyone who carries a balance of over $250,000, and I think that's still the same amount, could have money taken directly from their account without permission to help a bank from going under. And that is what you sign on when you deposit money into the bank. And that is legally stipulated in the Dodd-Frank Act. Am I expressing that correctly?
Perfectly. I want to take it one little step further, because they have tested this, right? In the US, we haven't seen a bail-in yet, but they really tested it in Cyprus, right? And that's super interesting because they first did it where they just took everything. But then there was a global outcry. Oh, deposit insurance, deposit insurance. So they backed off and they just took everything there was over 100,000 euro. Okay, so if you put €1 million in there, you just lost 900, but they also lost access to those funds. So they had this statement that said they had it, but they still, I think, don't hold me to this, but I'm pretty sure that it was more than 5 years before people could actually go in and withdraw more than a couple €100 a day or whatever that number was. And so this has been tested. And right after that test, the Bank for International Settlements, which is the central banker's central bank, came out with a report showing how they would do this over a weekend with or without deposit insurance. So even though they will likely honor that, they likely will. I mean, they don't have any money in the DIF anyway. It's kind of a joke.
But Lynette, riddle me this then, because we had the banking crisis in March of last year, and they didn't. They did actually keep depositors over $250,000 safe. They didn't invoke Dodd-Frank. They didn't invoke the bail-ins. They came up with the Bank Term Funding Program and other acronyms to basically print more money and give the banks the power to keep themselves afloat. They did merger some M&A deals, some marriages between bigger banks and smaller banks, but ultimately the Dodd-Frank bail-in clause was not kicked in. It did not go into effect. And as I said, even if you had over $250,000, you were safe with the banks that went under. So what happened there? Why did that not kick in the Dodd-Frank? Why did they opt to go another way?
They opted to go another way because they weren't ready for us yet to know that that would happen. But as that audio shows you, they know they're going to be using that tool. They just don't want you to know it.
So the audio that you're speaking about, it's a clip from the FDIC Systemic Resolution Advisory Committee, was recorded November 9th of 2022. And well, let's play it and then we'll discuss it on the other side, because it's basically discussing the importance of perception management and how we shouldn't make people too aware that this bail-in clause does exist. We'll play the clip.
It should be accessible when people need to know, but I don't think you have much hope of reaching a public that doesn't have a professional need to know.
I completely agree with that. I almost think you'd scare the public if you put this out. Like, why are they telling me this? Should I be concerned about my bank? Like, my insurance company doesn't tell me what they're doing with my assets. They just assume they're going to pay my claim, right? I think you've got to think of the unintended consequences of taking a public that has more full faith and confidence in the banking system than maybe people in this room do. That we want them to have full faith and confidence in the banking system. They know the FDIC insurance is there. They know it works. They put their money in. They're going to get their money out. So there's a select crowd of people that are in the institutional side. And if they want to understand this, they're going to find a way to understand this. There's a bunch of law firms represented in this room. There's a bunch of people that will charge them by the hour a lot of money to explain this all to them. And it's fine. I don't have a problem with that. And they all have huge staffs. But I would be careful about the unintended consequences of starting to blast too much of this out in the general public.
Yeah, Lynette. So they're saying the public has more faith in the banking system that they do. They want to manipulate public opinion, choosing to keep people in the dark about the rules, about the true state of the banking industry. They're not saying that the information is out there. They're just saying, well, let's not draw too much attention there. And speaking over there predominantly was Gary Cohn. He's the IBM vice chairman, but more importantly, Cohn was president and chief operating officer of Goldman Sachs for more than 25 years. He's also former director of the U.S. National Economic Council. So, there he is advising the others to, let's just keep it a little quiet that this exists. Let's hear your thoughts on that.
Oh, absolutely. I mean, I think that audio clip really says it all. We are just sheeple. We are the right size to fail. And I think that it's just about timing, right? It's just about timing. Would they want those knowing in the regional banking sector that this could happen to the larger banks, or would they rather wait until the larger banks are experiencing a run to shut it right down? And, it's funny too, because he brought up the insurance company, right? Well, when did the FDIC come into existence? 1933. And there's a reason why they did it, and it was about regaining that public confidence. And so when you hear, well, it's insured, and I can't tell you how many times I've heard that, and even in people that put their wealth in annuities or in insurance companies, you've got to read the fine print. It's a contract. What does it say? It says based on the claims paying ability. Oh, that says it all, doesn't it?
Lynette, correct me if I'm wrong, but wasn't 1933 also coincidentally the year that owning gold was made illegal in the United States?
Yep. That is absolutely correct. And that's when they took the power away from the public, and we allowed it, and we can't allow it anymore, because now, in my opinion, what they have in mind for us takes us back to feudal times. And I'm not worried about me. I'm old, but I am worried about our grandchildren, all of our children, all of our grandchildren, and the legacy that we're going to leave them.
Okay, but then, Lynette, why not continue this charade? Why not just create more money, bail out the banks yet again? Don't create too much chaos within the people. Come up, if it's not the bank term funding program, it's some other acronym, it's some other ways to keep the banks liquid, to keep the system afloat, to keep, the charade going on for longer.
It's the value of the currency that prevents that. It's not me. It's not even them understanding what's happening. But if you have to spend that money as quickly as you get it in to make sure that you can buy whatever little bit that you can buy to hold its purchasing power, it's the money printing machine that's going to do that. It's not going to be an understanding necessarily of all of these details that you and I are talking about today. It's personal experience. And the less that people can go in and support their family unit, the less food they can buy, the less quality that they can buy, that's going to create a problem, because people that are hungry and hopeless, they make different choices.
Yes, and people that are hungry and hopeless are more subject to control and to influence. But where are we then in terms of what your read is on the health of the banking sector?
I think the banking sector is extraordinarily sick. And, how much would the central banks this is global, it is here, but it's also global. How much do they have to, if the value of the bank's holding, because remember, this isn't just bonds, this is all of the mortgages, all of the auto loans, all of the student loans. It's all debt is way underwater from that 15-year accumulation of debt at zero interest rates. This quarter of a point isn't going to do anything. They have to do a massive, I know people think that this isn't going to happen again, but I'm sure we will see interest rates drop down to zero. I'm 100% certain, because they need the value of all that debt to go up, since every single bank is insolvent. And this is all about confidence. So they just need to prevent a run. And when people get hungry and hopeless, and it's getting harder and harder to take out cash or do wires or do any of that, people are actually starting to notice how much harder it is to have access to the money that they have in the banking system.
Well, you mean harder to take out physical paper notes for whatever value they may have, with fewer ATMs and charges for that.
Exactly. And even walking into the bank and requesting cash, right? They, depending upon the level, oh yeah, if you go in for a few $100, they're not going to say anything. But if you go in to take out what I wouldn't even think of as a substantial amount, but like $10,000, okay, we have to report this.
Right.
Why?
And oddly enough, they haven't raised that $10,000 to keep up with inflation, right? It's curious because they've kept it at that $10,000, whether that's coming into the country with monetary equivalent of $10,000, taking out $10,000. That hasn't kept up with inflation at all. I believe that figure has stayed static for at least I'm going to throw out like 30 years here. I could be wrong, but certainly for the past 20 years, I think they've kept it at that $10,000 level, and they due for an inflation adjustment there. Lynette, though, help us bring it all together now. We've covered some of the basic terms. We've covered some of the issues that you're concerned about. Paint the timeline, paint the picture of how you see this all unfolding.
Timing is the biggest challenge. I can tell you what is most likely to happen, but exactly when is more challenging. I would think, though, that when they drop the interest rates, we're going to see a spike in inflation. And I think that is really the death knell. And that's why I said we're probably going to become more aware of it in 2025, which is not that far away. So we're very close to that, but it's so important for people to already be prepared. Food becomes the biggest issue. Most people have enough food for 3 days, and grocery store. I mean, do we not remember what happened in 2020? So I would say you want to be prepared now, not wait, because quite frankly, it takes an awful lot of preparation to be in the right position, or hopefully in the right position to have food, water, energy, security, barterability, wealth preservation, community, and shelter. That's my mantra. That's what I've built up around myself so that I can be as independent and self-sufficient as possible inside of community. That's where this becomes absolutely critical.
I mean, I get be prepared. And again, we'll circle back to that, but I just want to have a more concise sort of play-by-play, and we'll keep the timeline a bit loose. But you're saying, okay, the Fed comes in, starts cutting rates. Mm-hmm. Talk us through that. Talk us through the process of how we get to the hyperinflation and the collapse.
Again, it all goes back to confidence. But as they start reducing rates, they're doing that to generate inflation. And ships, massive barges do not turn in a thimble of water. So have they gone too far with holding the rates up at this level? I don't know. We're about to find out. But dropping the rates to prevent the collapse of the corporations, because Michelle, here's a question that I have for you. And I don't know if anybody can really answer this, but corporations are certain that the Fed's going to drop the rates more than a quarter basis points, right? But there seems to be a global flood of new corporate issuance of debt. Why are they issuing debt at these higher rates?
Right. Yeah.
Does that make any sense to you?
Well, immediately need to plug a hole, I guess, because they can't wait for that.
See, there you go. Or when you know that you're going bankrupt, spend all the money you want. It doesn't really matter what the interest is, because I think that the collapse is, I think 2024 was a very pivotal year. I think 2025 is going to be a much more visual year. I think that the rules that have been put in place that create an awful lot of market volatility, that short-termism. And what did the talking heads say? Well, if you're a long-term investor, don't worry about it. So I think we're going to see a tremendous amount of market volatility. Will it be covered up by more interest rates dropping? I think in 2025, we very well could see interest rates drop back to zero. However, That's not going to fix the problem. That's only going to, they're between a rock and a hard place, because when they lower that interest rate, it's going to create more inflation. They create more inflation. The public notices because they can't buy as much with the dollars that they're earning. And now in the labor market, it's a soft labor market where you have fewer job openings, more layoffs. I mean, and everything is dependent on the consumer consuming. But boy, is that really what they're going to be able to do? So I think that next year in 2025 is when we're going to see a spike in unemployment at the same time that we have a spike in inflation. And I think it will become obvious and continue. And whether or not consumer confidence will completely erode in 2025, but it could. I can't say for sure because my crystal balls don't work very well, and neither does my magic 8-ball.
I also have a magic 8-ball. I make all of my major life decisions based on the magic 8-ball. Lynette, on a serious note, though, what happens in the rest of the world? Because you keep on stressing that this isn't a U.S. issue, that this is a fiat global currency issue, that the faith is not just about people losing faith in the U.S. dollar, but globally.
Right. Yeah, exactly. So we are seeing that there are more and more countries that are in hyperinflation and doing overnight resets. There are more and more countries, particularly, I think there's like 10 or there's that list of countries in Africa. We're seeing a rush to repatriate gold. We are seeing central banks buying the most gold that they ever have in history. And that trend is continuing. Why are they buying gold if it's not because they know darn well what they're doing to this stuff? And they want to retain their freedom and they want to retain their control of their own destiny. It's exactly the same reason why you and I need to be loaded up with gold and silver. Silver for barterability, gold for wealth preservation and growth.
So then let's take it a step further. You're seeing the global monetary system shift dramatically, not just away from the dollar, but shift to what?
Oh, shift. Well, actually, when you're doing those shift to hyperinflation, shift to the death of their currency. And it always starts in emerging markets in the weakest areas first, and then it grows to the medium economy and ultimately to the advanced economies. So I think that next year we will see more and more hyperinflationary events. I mean, that's what the data is saying. I wish I could say something different. I have babies. I have grandchildren. This is not the world.
In terms of the currency, does this mean we go to a commodity-backed currency? Does this mean we go to some kind of reintroduction of the gold standard? I mean, you know, as we've discussed on this show before, there's some speculation that the BRICS are trying to come up with some common currency backed by commodities. When we see this collapse, or does this then usher in some universal central bank digital currency? Like, what happens when the faith is lost?
Well, when the faith is lost, history shows us 100% of the time, and I don't think this time will be different, that they will come in and they will bring gold as a backing of the currency. Not 100% backed, but a percentage backed. It's why I'm watching Zimbabwe so closely with their ZIG, Zimbabwe gold, that is presumably partially backed by gold, and then foreign currencies, which I think are the dollar. It's really hard to ferret out all that information because they're not really forthcoming with it. But they're having trouble adopting it because it's non-convertible. So they can say anything. But yes, and when you talk about a universal currency, the IMF and their currency, which is a basket of currencies, and there's no limitations, they could put every single currency in that basket. They've been working very, very diligently on creating that universal currency. And so I think, and even when you're talking about the BRICS countries are voraciously accumulating gold. The Western countries like the US and the other advanced economies, not accumulating so much. But those that are part of the BRICS nation, yes, they are. And there are a number of countries that are repatriating their gold because if you don't hold it, you don't own it. And they know it. So they're calling in their gold so that it's close to home and they have full access to it. And the one that probably makes me the most nervous is Saudi Arabia. And I say that because they're the ones that have supported a petrodollar, even though that hasn't been kind of fully accurate, but they became a member of the BRICS. They are repatriating their gold. They are growing the gold that they have in deep storage, and they are distancing themselves to a degree from the U.S.
Right. I think the Saudis have not officially joined BRICS. They've sort of been carefully straddling that line, playing both sides for now. They're kind of neither confirming nor denying. They're playing both sides just to see how things shake up, but certainly have moved away from the U.S. to some degree and closer to the BRICS countries there, which brings me to the question of many are saying that the U.S. is at a pivotal point in terms of this next election, that this could dramatically accelerate this process, maybe delay it. I don't know if it can derail it ultimately, maybe derail it or delay it further. Does this election outcome have any bearing on how you see this global monetary system evolution play out?
Not really, because both parties are talking about spending. They're both moving us in that direction. And I've done studies on the laws on the books pertaining to gold and all of this. And what I've noticed is whether it's a Republican Party or a Democratic Party, there is an agenda and they are moving us along. And also when you look at, I don't get political. But when you look at the quality of the candidates, that really is indicative of where we are in this trend cycle. Look at President Nixon back in 71. And then in 75, I happened to be going to school in England then. I was just talking about this earlier. And there was Watergate, right? And we were shifting systems. There are just so many parallels between now and the 70s and 80s and back in the teens, 1913 through the 20s and through 33. I just see so many parallels of shifting into different currency regimes. Those are those repeatable patterns. They happen every time. Do you think possibly this time could be different? Because that's what they want everybody to believe.
Well, one pattern that we've seen throughout history is a return to gold. Right? That's factual. I mean, we've had guests on the show that are pro Bitcoin. I know you're not. I personally do see the value in Bitcoin, but historically, one can't deny the fact that gold has stood the test of time for thousands of years. It's just defaulted to gold. Why would that not change the way gold is viewed then? Because we've also seen, why is it safe to hoard gold? Why wouldn't governments then come and change their position on gold as they've done in the past?
Well, I think they will, to be perfectly honest with you. I know a lot of people go on hopium that, it doesn't back the currency anymore and it's an old relic and all of that. But really what gold is confidence, because it's used in every single sector of the global economy. So it's full utility. And so, I think that we will see gold come back in when they have to regain the confidence of the public, because you're right, that has happened 100% of the time, over 4,800 times, and growing. That list is constantly growing and rapidly growing these days. So yeah, I think we will see that. And then once they regain the confidence, see, I'm saying it must be convertible. If you cannot convert whatever the currency happens to be into the physical metal, then how do you know that it's there? How do you know that it actually matters? You don't. You have to have the ability, the public has to have the ability to hold those that we elect. We have to hold their toes to the fire. And we also have to have the ability to hold the toes to the fire of the Federal Reserve or any other central bank that are unelected and private banks.
So which one is it, Lynette? Do we go back to gold, or do they use this to usher in the central bank digital currency? Or do they use the crisis to come out with the CBDC, which is a reminder to our viewers, is a form of digital currency issued by a central bank, which allows the government to surveil every single transaction, obliterating privacy and anonymity. The currency can be programmed, so certain transactions can go through or cannot go through, depending on the law, depending on the whim, depending on how much favor you may be found to have within the system if a social credit system is implemented. And as you also just pointed out, it could also fine-tune monetary policy by injecting money into the system, removing money out of the system, putting a time limit into when money would be spent. Quick recap on a CBDC. Is it going to be, we've lost faith in this current monetary system, we're going to a gold-backed system as a government, or we're using it to create the crisis to bring in the CBDC? Which one is it?
Well, I don't know that they have to be absolutely exclusive. This is my battle. And honestly, I'm taking on this huge battle. But I think that this is where community comes in. Because if we just allow it to happen, then you get what you deserve, which is loss of everything, loss of your freedom, loss of your privacy, loss of your rights. So this is where I believe we really have to come together in both a local community to secure that you have enough food, water, energy, and all those pieces that I mentioned before. But even more important is we have to, on a statewide level, work really diligently to get the states to legalize gold and silver as legal tender and then go global with it. Because what we need to do is have a seat at the table, which means I would like to see the public represented by somebody in the public that is sitting at the table determining what this next monetary system is. And I know that's like so big that it's almost overwhelming. And I don't know whether or not this can be done, but I do know that I'm going to die trying. And if every single person comes together, or if we get 3% of the global population to create this quiet revolution just by converting this garbage into sound money, then they're going to have to give us a voice. They're going to have to say, okay, what can we do? Or they're going to lose complete control, I hope.
So, Lynette, viewers will watch this and go, she's talking her book. You know, she sells gold, right? She sells, she's advocating for people to buy from her. She's an extraordinary saleswoman. What do you say to that?
Well, number one, I can't sell to the whole world. And number two, I've been on Zang Enterprises on our YouTube channel. I've been sharing a lot of the strategy that I've developed based upon those repeatable patterns. So I'm kind of giving it away. Plus, do you know, Jackson's not going to like me saying this, but do you know what our minimum is?
I do not.
1 ounce of silver. We ain't making any money on that. So I feel so strongly that everybody all around the world needs to own gold and silver. But what should I recommend, right? Should I recommend the stock market that I know is severely inflated and garbage? Should I recommend the real estate market? I could say the same thing about it. It's severely overvalued. I believe so strongly that you need to have the lion's share of your wealth in an undervalued asset that is in a long-term positive trend and the least amount of your wealth in an overvalued asset that is in a long-term negative trend. Even the manipulated spot gold market is in a long-term positive trend. And you know that because there is a series of higher and higher lows. And if you keep getting higher lows, you're going to get higher highs. On the flip side, the real trend is in the purchasing power of the currency, because 1 trillion times zero is zero. And you know you're in a negative trend when you see lower and lower highs, but go to the grocery store, try and buy some insurance. In some cases, you can't even do that anymore. But anything that you're buying costs you more of this stuff. And it is really, that's the real trend, not the stock market going up. We saw Venezuela, we see in Zimbabwe. Oh yeah, Zimbabwe, when they did their overnight reset back, what was it, April 8th or something like that? The stock market lost 360%, bam. So people fly to that thinking that that's going to protect them from the inflation, when in reality, you can only convert it back into this. So I'm doing gold and silver because I know that that's what we need. We need sound money. This is a currency life cycle issue. And so what are the currency metals? Primarily gold, secondarily silver. That's why.
As we wrap up here, you've mentioned sound money, sound money, sound money. We say that all the time. What does sound money mean?
It means that it holds its purchasing power over time, so that no matter when, what value do we have but our labor, right? And our time. That's really what we have. And so if I get paid today, I want to be able to save that money to use it sometime in the future, but I want to get paid the same amount as when I earned it. With this stuff, that doesn't happen by design. But with this stuff, it does. So sound money means that you hold your purchasing power over time and you are always fairly paid for your labor. The sound money is what does that. The fiat does not do that.
So given that you're saying sound money, gold, is still severely undervalued, even though we've been making new all-time highs, and as you say, the lows are getting higher, do you have a price outlook for gold in line with your 2025 potential hyperinflation kicking in? Where do you see gold at the end of 2025?
Really wouldn't surprise me to see it somewhere around 5,000 an ounce, and it'll still be undervalued then. Because the more of this that they create, the higher the fundamental value in terms of that it goes.
5,000 an ounce seems ridiculously underpriced if you're projecting hyperinflation, which, as we've said, is 50% a month. That doesn't even remotely keep up with that.
No, it really doesn't. But also understand and look at what happens to gold and silver in government regimes where they are suppressing the price until they do that overnight revaluation. That's when it begins to go to its fundamental value. But they're still not wanting people, and they're not going to want people to hold physical gold and physical silver, especially physical gold more than the silver because of the industrial use of the silver. So yeah, we will not see gold expressed to its true fundamental value until we begin this series of overnight resets. And it won't happen in that first reset. And I can't tell you how many resets we're going to have, those overnight devaluations. I could tell you that globally on average, historically, we'll have 3. But we've seen Zimbabwe's on its 6th iteration of a new currency, and so is Venezuela. So I can't tell you how many we're going to get, but no, you're not going to see gold expressed to its true value until the government really needs to regain that. Because even though the hyperinflation I mean, I think it's already kicked off, right? And we're certainly not at 50% inflation at this point, but there's always a beginning, a middle, and an end, right? So I think we're in the beginning, and I don't think we will peak in 2025. I just think that it will become more apparent.
Okay.
And you're right. I mean, 5,000 is nothing because honestly, fundamental value is somewhere. I mean, I don't check it all the time because it's not really necessary, but it's somewhere north of $40,000 now, right now.
Right.
And the more that they grow, the higher that will go.
All right. So we don't peak in 2025, may not even be full on hyperinflation, but the trend certainly starts to move in that direction. Lynette, final thoughts as we wrap up here. And I think it's important to stress this idea of community that you've been such a strong advocate of.
Well, I feel like we need to do it on two different levels. Locally, so that you can secure the food, the water, the energy security, and be able to barter within your community, your labor, or anything physical, including silver. Even George Gammon, when he went down to, I think he was in Medellin or something like that, had the best luck using silver for barterability, but it was inside of the community. So, you know, most people are not completely self-sufficient. So you need to have a community that has a variety of skill sets to survive. And when the government says jump, you don't have to say how high. I think the community coming together in the U.S. to help states push through the legalization of gold and silver and put pressure on the federal government is something that we all need to be working for. But on a global basis, to have a more fair system, then again, it's that quiet revolution of just converting your fiat money into sound money, physical gold and silver in your possession. Because we should all be so aware that if you don't hold it, you don't own it. And if somebody else is holding it, they can say no because it's just a contract. It's not real. So if enough people, even 3% of the globe starts to accumulate gold and silver, that could very well, I mean, I'm hopeful on this. I can't guarantee it, but that could buy us a seat at the table in this next iteration of money that is much more fair. Not just for us today, but I'm so concerned about moving into the future and what that looks for our grandchildren.
Yeah, the next iteration of money. And again, I always like to say we all have recency bias, but these new versions of money, of the monetary system, of the financial system by which the world is governed has changed throughout the history of man. And there's no reason why we can't be on the precipice of another change that hopefully we can shift back to sound money principles. Lynette, thank you so much for being such a strong advocate for that. Always a pleasure chatting with you, Lynette Zang.
Yes, you're one of my favorite people, Michelle. Thank you so much for having me.
I'd love to hear that. I'm looking forward to coming and checking out the bug out there.
Oh, I'd love that. I would love that. And so will you. And I'll even let you ride the new ATV.
All right. As I said, I'm definitely going to take you up on that. We'll hope to see you soon. Lynette, thank you so much. And a big thanks to our sponsor, Goldbacks. And for our viewers that are not familiar with this easily portable form of gold, Goldbacks are physical, interchangeable gold currency made of real 24-karat gold. And these are gold notes with real gold woven inside. The gold is vacuum deposited using state-of-the-art proprietary technology. And with Goldbacks, you can help protect your wealth against fiat currency debasement and devaluation through the stability of gold because they are made with real 24-karat gold and they appreciate with the price of gold. Goldbacks allow you to own and spend gold in small interchangeable increments, and you can buy Goldbacks for as little as $5. And Goldbacks can actually be used as real money from small to large transactions. There are over 5 states where Goldbacks can be used to pay for goods and services, from a growing list of over 2,000 businesses where Goldbacks are accepted as payment, from coffee to sneakers to RVs to services like chartering flights, getting your car repaired, and even paying for accounting services. And there's also a way to earn interest on the goldbacks that you own, paid back in goldbacks. You can get all the details for that at goldback.com. So if you want to diversify your gold holdings and get some goldbacks, there is a link in the description of this video with where and how you can buy your goldbacks. So make sure to check that out. As usual, thanks for checking us out. And please feel free to leave us your comments. Praise, whine, or just opine. We read the comments and we love hearing from you. From me, Michelle McCory, and the rest of the team, we'll see you soon.
On the Spot with Michelle McCory is brought to you by Goldback, inflation-resistant 24-karat gold currency. Protect your purchasing power, grow your wealth annually, and spend at over 2,000 businesses. Learn where to get Goldbacks at goldback.com.